Yes. So, and today, or in today's session, I want us to start on this new topic, and the topic is earnings per share, or basically EPS. So, if you can be able to recall what you did in financial reporting and also financial accounting, you came across this particular term here, earnings per share. So, basically, earnings per share is a ratio which is computed by companies at the end of the year, and according to this particular standard here, that is International Accounting Standard number 33, all the listed companies, or basically those particular companies whose shares are trading in the securities exchange market, are basically required to compute and disclose two types of earnings per share. So the two types of earnings per share to be computed by those listed companies include the basic earnings per share and also the diluted earnings per share. And therefore, in this particular topic here, we are going to look on how we compute those two types of earnings per share, the basic earnings per share and the diluted earnings per share. But even before we look on how we compute those two types of earnings per share, we need first of all to ask ourselves, what is the earnings per share? So the earnings per share, as the name suggests, this refers to the amount of profit, or basically the amount of earnings, which is attributable to each equity or ordinary share which has been issued by by the company. So therefore, we are saying EPS is the amount of profit, or is basically the amount of earnings, which is attributable to each ordinary or basically equity share, which has been issued by by the company. So that amount of profit, or basically that amount of earnings, which is attributable to each ordinary or equity share issued by the company, that is basically the earnings per share. Remember, in this case, what you have said is that all the listed companies are required by this particular standard here. International Accounting Standard number 33 requires any company which is listed. Remember, in this case, we have said that a listed company, basically this is a company whose shares are traded in the securities exchange market. For example, in Kenya, good examples of listed companies include companies such as maybe Safaricom, companies such as Equity Bank, and so on. All these companies are listed simply because their shares trade in the Nairobi Securities exchange market. Now, what you have said is that these particular companies here, they are required to compute earnings per share, or basically two types of earnings per share: the basic earnings per share, abbreviated as BPS, and also the diluted earnings per share. So at a later stage, we're going to look on what you mean by each type of earnings per share there, and basically how do we compute the basic earnings per share, how do we compute the diluted earnings per share. But even before we do that, we can look on the significance, or basically some of the importances of these earnings per share. So why are companies required to compute the earnings per share by this particular standard? One is that the earnings per share, basically which you're saying, it is a ratio which is computed to show the amount of profit attributable to each share issued by the company. Number one, this earnings per share can be used by the shareholders, of the company, basically to evaluate the company's profitability. Profitability. So if you want to know how profitable the company is, you can basically use now the earnings per share, because we are saying this earnings per share shows the amount of profit which the company generated for each share you hold in that company. It basically means that the higher earnings per share, the more the profitable the company is. So therefore, number one, it can be used by the shareholders of the company in terms of doing evaluating the profitability of the company. Number two, the shareholders of the company can also use these earnings per share basically to compare the performance, or basically to compare the profitability of two or more companies within the same industry. So meaning that as a shareholder of the company, you can be able to use this particular earnings per share basically to compare performance of two or more companies. You can use this earnings per share to compare how different companies within the same industry are doing are performing. For example, maybe assuming you have three companies here, company A, company B, and company C, and these three companies have computed their earnings per share. Let's assume the earnings per share for this company is 2 shillings per share. For this one is 5 shillings per share, and maybe this one is 8 shillings per share. In this case, you can see we can use these earnings per share basically to compare the performance of these companies. Remember, you have said if the earnings per share is higher, it basically means that that company is more profitable. So therefore, you can say this company is the one which is more profitable in that particular industry. So therefore, earnings per share here can be used by the shareholders of the company to compare the performance or the profitability of two or more companies within the same industry. Number three, the shareholders of the company can also use this earnings per share basically to do something called a trade analysis. So when we talk about trade analysis, this basically whereby you are comparing the performance of the company over a number of years. So if, for example, the company has computed the earnings per share, maybe for year 1, year 2, year 3, and you're given those particular earnings per share, maybe the earnings per share here, for example, was 5, here maybe it was 3, and here it was 2, then in this case, you can use this earnings per share basically to compare the performance of the company in those 3 years. You can see here the earnings per share was higher, but basically that earnings per share is reducing over time. So in this case, we can make a conclusion. You can make a conclusion as a shareholder of this company that the profitability of the company has been decreasing rather over years, has been decreasing. So therefore, you can use the earnings per share as a shareholder basically to compare the performance of the company over a number of years. Finally, the earnings per share is also used to compute something called the price-earning ratio. It is used in computing the price-earning ratio. Price-earning ratio basically is another type of a ratio. How do we compute this price-earning ratio? We take P. Basically, P represents the market price per share. The market price per share divided that with E. E here stands for earnings per share. Earnings per share, we then multiply that with 100. So in this case, you can see, for us to be able to compute this particular ratio here, that is the price-earning ratio, we must be having what? We must be having the earnings per share. So that's why we have said that the earnings per share here is also used in computation of another ratio, which is basically known as the price-earning ratio. So therefore, these are basically some of the uses of this particular earnings per share. And basically, that's why we are saying it is important that any company which is listed at the end of the year, other than preparing financial statement, that company has to compute and also include as part of the notes 2 types of earnings per share. Basically, for the shareholders of the company to be able to use those earnings per share to do all this. Now, in this case, remember, we have said that we have 2 types of earnings per share to be computed and also disclosed by all the listed companies. So which are those 2 types of earnings per share? We have the basic earnings per share. We can just note them here, types of earnings per share to be computed by the listed companies. We have the basic earnings per share. This one is abbreviated as BEPS. And number 2, we have the diluted EPS, abbreviated as DEPS. So these are the 2 types of earnings per share, which any listed company has to compute and basically disclose. Disclose means that once these earnings per share have been computed, they must be included as part of the notes. As part of the notes which accompany the audited financial, or basically which accompany the financial statement of the company. So I want us to start by looking on how we compute the first type of earnings per share, which basically is the basic earnings per share. Basic earnings per share, BEPS. Now, the basic earnings per share, first of all, this is an earnings per share which is computed using the profit for the current year and also the shares issued and fully paid at the end of the year. So meaning that to compute this earnings per share, or in other terms, this is earnings per share computed using a profit for the current year, of which in this case, we talk about the profit, like in financial management, we talk of earnings. So the profit in this case can also be known as what? Can also be known as earnings. So we use the earnings, or basically the profit for the current year, and also the number of ordinary shares. The number of ordinary shares issued at the end of the year. Issued at the end of what? At the end of the current financial year. So therefore, to compute this basic earnings per share, this is the formula which we use. Basic earnings per share. We take something called the profit. The profit. Remember, the profit you have said can also be known as the earnings. Earnings, which is attributable to the ordinary shareholders. Attributable to the ordinary shareholders, and basically this one or is abbreviated as PATOS. is abbreviated as PATOS. So what do you mean by PATOS in full? PATOS, this one stands for profits attributable to ordinary shareholders. The profits attributable to ordinary shareholders. And then we divide this with something called the weighted average number of ordinary shares. And this weighted average number of ordinary shares, this one is abbreviated as 𝗏𝑂𝑠. This one is abbreviated as what? 𝗏𝑂𝑠. So 𝗏𝑂𝑠 means what? Weighted average number of ordinary shares. So therefore, in this case, we can say basic earnings per share. This one is computed by taking the PATOS, the profit attributable to ordinary shareholders, divided start with what? With 𝗏𝑂𝑠. Weighted average number of ordinary what? Shares. So how do we compute these two items here? How do we compute PATOS? How do we compute 𝗏𝑂𝑠? We can start by looking on how we compute the PATOS, the profit attributable to ordinary shareholders, which can also be known as the earnings attributable to ordinary shareholders. So this one is computed by taking the company's profit after tax. The profit after tax, this one can also be known as the net income. This one can also be known as the profit for the year. The profit for the year. So the examiner can use any of the words there. So you have to know that all those words can be used what? Interchangeably, but they mean one and the same thing. Profit after tax, net income, a profit for the year. So we take that profit, then we less the preference dividends. The preference dividends for the current year. For the current year. And then when computing the earnings per share for a group of companies, if you can be able to recall what you did in the topic of group accounts, this particular profit for the year reported by the parent company, or which is determined by preparing the consolidated income statement. This profit usually is split into two: the profit which is attributable to the parent company, and number two, the profit attributable to NCI, the minority shareholder. So therefore, to this profit for the year, in case we are computing the earnings per share, or the basic earnings per share for a group of companies, to this we less the profit which is attributable to the NCI. We less the profit attributable to NCI, such that what we shall be left with is the profit attributable to the members of the group. Also, in case you are given this one, remember, has to be deducted. In case you are given, or you may be told that this particular profit here, this profit for the year, includes something called a loss. Includes something known as the loss from discontinued operations. Discontinued operations. Basically, when we talk about a discontinued operation, this is an operation of an entity which has been discontinued, or a component of an entity which has been discontinued. A good example of a discontinued operation is basically maybe a branch which has been closed down. A branch which has been closed down. Why? Because that branch has been making what? Losses. That is a discontinued operation. Another good example of a discontinued operation is basically a subsidiary company which has been disposed. The parent company maybe had a number of subsidiaries, but because one of the subsidiaries has been making losses, that subsidiary has been sold. The parent company has sold all the shares it held in that what? Subsidiary. It is called a discontinued operation. So in most of the cases, an operation of a company will be discontinued because that operation has been making losses. So you can be given this profit for the year, and you're told that profit included something called the loss from discontinued operation. Now, what is important here for you to note is that in computing the two types of earnings per share, the basic and also the diluted, according to IS 33, we use the profit from the continuing operations only. So the continuing operations are basically those operations of the company which are still in operation, branches which are still in operation, the subsidiary companies which are still held by who? By the parent company. So we use the profit from the continuing operation. So therefore, if you're given this and you're told it includes loss from discontinued operation, what you do, you come here and you add the loss from discontinued discontinued operations, you add it there. So someone may ask, why are we adding this loss here? Yet we are saying that when computing the basic and also the diluted earnings per share, we should use the profit from the continuing operations only. Why are we adding this loss? The reason why we are adding this loss to this profit is because this particular profit which you are given for the year, it basically includes the profit from the continuing operations and the loss from discontinued operations. So this loss has already been deducted in arriving at this. How do you exclude that loss, which was already added or which has already been deducted here? So you add it back because that loss reduced this word profit. So what you do, you come and you add it word back here because it reduced that profit for the word for the year. So whatever you get down here is basically known as PATOS. Is known as what? A PATOS. But in relation to this dividend here, there is something which is important for you to note, that the preference dividends which we get here must only be for the current year only. Must be for the current year only. That's why I've noted that this dividend should only be for the current year only. The other thing which is also important as far as these dividends are concerned is that you can be told that a company has issued redeemable preference shares. You may be given that information that the preference shares issued by the company are redeemable. So if you come across that information, there is something you have to recall, which you did in financial reporting and analysis, that the redeemable preference shares to the company, these are non-current liabilities. These are non-current what? Liabilities. What does that mean? It basically means that if a company has issued preference shares which are redeemable, these are preference shares which have been issued, but the company has to redeem them after a number of years. So if they are to be redeemed, these are equivalent to debentures. These are equivalent to the board. So when the company is preparing the balance sheet, the statement of financial position 1, they are non-current what? Liability. There is something also you have to recall, you covered in financial reporting and analysis regarding the year dividend. Who can be able to recall this? The dividend for the redeemable preference shares. How do we account for this dividend? How do we account for them? Or they are classified as part of what? This is something you did in financial reporting and analysis. Who can be able to recall the dividend on the redeemable preference shares? Those who are my students should be able to remember this very well. Dividend on redeemable preference shares. How do we account for this? How do we account for this? Who can be able to recall? No one who can be able to recall. Patrice, you can't be able to recall. So we said, Otunga, you can't be able to recall this. Maneno bana tulisoma kwa efale. Na watu wamesahau. So we said that the dividends for these redeemable preference shares, these dividends are treated as part of the finance cost. That is something you have to recall, that the dividends on redeemable preference shares, they are accounted for as part of the finance what? Cost. We know finance cost is an expense. So meaning that in arriving at this particular profit here, all expenses have been deducted, including the finance cost. So therefore, if you come across a question for computation of earnings per share, and you are told that the preference shares issued by the company are redeemable, are what? Redeemable. Never make a mistake of deducting their dividends here. You should not deduct their dividends here. Reason being that those dividends on redeemable preference shares were accounted for as part of the finance cost. Finance cost we know is an expense. So if it is an expense, in arriving at this profit, all the expenses, including finance cost, have already been deducted. So therefore, dividends on preference shares which are specifically redeemable, we don't list them here because they have already been deducted in arriving at that what? A profit. Sasa, yes. So that basically what you need to know in relation to the computation of what? The profit attributable to ordinary shareholders. So the next I want us to look on how do we compute this? How do we compute the one-offs? How do we compute the one-offs, the weighted average number of ordinary shares? So let's look on how we compute the weighted average number of ordinary shares, the one-offs, weighted average number of ordinary shares. Now, this one is computed by taking what? This one, remember here we are referring to the weighted average number of ordinary shares. So we compute this by taking the number of ordinary shares, or actually in other terms, you can just refer to this as the balance brought down. The balance brought down. So the balance brought down basically refers to the number of ordinary shares, the number of ordinary shares outstanding at the start of the year. At the start of the year. So in this case, when we talk about the number of ordinary shares which were outstanding at the start of the year, this basically refers to the ordinary shares which were issued and free paid at the start. So these are what? These are the number of ordinary shares. Number of ordinary shares issued and free paid at the start. And free paid at the start of the year. At the start of the year. So you have to determine how many ordinary shares had been issued by the company, or how many ordinary shares had been issued and free paid at the start. And then now to this, what do? We add the other shares which were issued by the company during the current year. So to this we add the shares which were issued during the current year. We can just refer to that as issues, or the shares which were issued by the company during the current year. Now, the shares issued by the company during the current year, these shares, basically, we classify them into two main categories. The shares which the company issued during the current year, we classify them into two main categories. Number one, we have shares issued at a full market price. Shares issued at full market price. And number two, we have issue at nil consideration. At nil consideration. Now, the shares which are issued at nil basically we know is zero. So these are the shares the company issued during the current year free of charge. A good example of these shares issued free of charge is basically a bonus issue. A bonus issue. Bonus issue, we know that these are the shares which the company issued during the current year to who? To the existing shareholders free of charge. Now, these shares which were issued by the company during the current year, and they were issued free of charge, we add them to the shares issued and free paid at the start, of which these particular shares here we say that they are not supposed to be weighted on time basis. They are not supposed to be weighted on time basis. They are not supposed to be weighted on time basis. I'll be able to explain more what we mean by that these particular shares are not weighted on time basis. But those particular shares which are issued at full market price, these particular shares here, they are weighted on time basis. They are weighted on time basis. I'll be able to explain what you mean by the shares being weighted on time basis. Like in this case, let's assume that we are told that the financial year of the company starts on 1st January and basically end on 31st of December. So that is when the year is starting and basically ending on that date. And then we are told on 1st of July here, which is basically 6 months to the end of the year, our company issued like 2 million ordinary shares at full market price. So when we talk about the shares being issued at full market price, it basically means that the shares were issued by the company during the current year at a price equivalent, or at a price equivalent to the market price. The market price is the price at which the shares of the company are trading in the securities exchange market. So if the shares of the company are trading in the securities exchange market, maybe at a price of 40, that is the market price or the full market price. So we are saying those particular shares which were issued in course of the current year at full market price, we are saying when adding them to the shares issued and fully paid, we should weigh them on time basis. It basically means that like these shares, 2 million shares, we must multiply them with the proportion of time they were held. These shares, we know they were held for 6 months out of 12. The shareholders just held those shares for 6 months out of 12. So in this case, we say that these shares have been weighted on time basis. On time basis. So meaning that the amount which we add here should not be 2 million, but rather in this case should be what? Should be 1 million. So those shares which were issued by the company during the current year at full market price should always be weighted on time basis. So the reason why we do that is because those who bought the shares of this company are only deemed to be entitled to share the profit of the company from the date the shares were issued up to the end. So they will only be entitled to share the profit from this date to that date. But now, those shares which were issued at nil consideration, e.g. bonus shares, in most of the cases, these are the shares which will be issued, for example, to the existing shareholders. So these shareholders have been fair. have been the shareholders of the company throughout the year. So therefore, even if the shares were issued to them at this date, they will not be entitled to share the profit for just 6 months because they have been shareholders of the company. They will be entitled to share the profit for the whole year. That's why we are saying those shares issued at full market price, they are not supposed to be weighted on time basis. If you are told on this date, 6 months to the end of the year, the company made a bonus issue of 4 million ordinary shares, those shares, you bring them here as 4 million. We don't multiply them with the proportion of time they were held during that during that year. So then basically what you do, you add all this. The shares issued and fully paid at the start, plus the shares issued during the current year at full market price and which have been weighted on time basis. Those shares issued during the current year at nil consideration, which you have said should not be weighted on time basis. We add all this. Whatever you get here is the one-off, the weighted average number of ordinary shares. And having that, and already you have computed per TOS, you proceed and compute the what? You proceed and compute the basic earnings per what? Per share. So therefore, those shares which are issued by the company generally during the current financial year, those shares, we classify them into two main categories: shares issued at full market price, and then the shares issued at nil consideration. But in this case, I want us to proceed and look on specifically how do we treat the shares. How do we specifically treat the shares which are issued by the company during the current year? During the current year, the company may make different types of issues. Like a company can make a bonus issue, a company can issue shares which are partly paid, a company can make a right issue. How do we deal with those particular shares? How do we treat those different types of issues which were made during the current year in the computation of the basic earnings per share? So in this case, we can talk of the changes in the number of ordinary shares. So what causes the number of ordinary shares which were issued at the start of the year to change? If, for example, the company had issued 2 million ordinary shares at the start, what will cause those shares to change? So we have various reasons why the shares issued and fully paid at the start of the year may change. Number one is because there were some shares which were issued by the company during the current year at full market price. It's because of issue at full market price. Issue at, or we can talk of issue of shares at full market price, full market price. Now recall, we have said that anytime the company issues shares during the current financial year at full market price, what should happen? Those shares should be weighted on time basis. That's just what you need to remember. Whenever you're computing the PATOS, these shares, we have said that should be weighted on time basis. Being weighted on time basis means that it should be multiplied with the proportion of time they were held. If the shares were held, like in this case, 6 months out of 12, take the shares issued at full market price, multiply that with the proportion of time they were held, 6 out of 12. Number two, we have issue of partly paid shares. Partly paid shares. These are the shares which were issued by the company in course of the current financial year, but when they is coming to an end, those shares will not be fully paid. Will not be fully paid. Now, in this case, for the purpose of computing the basic earnings per share, specifically in computation of our note here, we only consider the shares which were fully paid. So in this case, we have said in computation of our note, we consider shares fully paid. We consider shares which are fully paid. And basically, to compute the shares which were fully paid, there is a formula which we use. We use to compute them, the fully paid shares, shares. So we take, or basically we compute the amount received from the shareholders. So how much amount was received from the shareholders in relation to those shares which were issued, and then we divide that with the issue price. We divide that with the issue price. With the issue price. So the shares were issued at an amount of how much? Like in this case, assuming we are told the financial year of the company starts on 1st of January, and end on that is 1st of December, we may be told on 1st of October. 1st of October, how many months do we have here? To the end of the year, we have October, November, December. So this is basically 3 months to the end of the year. So in this case, we may be told that on this date, the company issued 2 million ordinary shares at a full market price of maybe shillings 40. So the shares were issued at a price of 40, but when the year was coming to an end here, the shareholders had only paid 20 shillings per share. The shareholders had only paid 20 shillings per share. What does that mean? It basically means that these shares at the end of the year were not fully paid. So in this case, we have said when computing the weighted average number of ordinary shares, we only use the shares which are fully paid. How do we compute the shares fully paid? This is the formula which we use. Compute how much amount had been received by the company at the end of the year. That will be equal to the shares which were issued. We know our company had issued 2 million ordinary shares, 2 million ordinary shares. We multiply that with the amount which had been paid per share. The shareholders had paid an amount of how much? 20 shillings. So the amount which the company had received from the shareholders who bought these 2 million shares was 40 million. Then divide that with the issue price. The issue price in our case is 40. And then you also have to recall, because these shares were issued at full market price, and they were only held for 3 months during that year, you have to remember this rule. Anytime the shares are issued at full market price, when computing the one-offs, you have to multiply them with the proportion of time the shares were held. So we multiply them with the proportion of time they were held. That is, we multiply that with 3 all over 12. 3 all over 12. So that's basically how we treat the shares which are issued, or basically the shares which are partly paid at the end of the year. Number 2, we have issue of shares. Issue of shares as a payment of purchase consideration. As a payment of purchase consideration. What do you mean by that? Issue of shares that, as a purchase consideration. In this case, there is a topic I think we will do, IFRS 2, a topic on share-based payment. Basically, what you need to note is that whenever, for example, you provide services to a company, or maybe you sell some goods to a company, or even an asset to the company may decide not to pay you in cash, but the company can pay you through shares. Basically, what that means is that once you provide such service to the company, or maybe you sell goods to the company will not pay you in cash, but basically the company will issue you with shares as a form of payment. Remember, shares is an asset. So the company will issue you with shares as a form of payment. Equally, if you can be able to recall what you did in the topic of group account in CPA intermediate level, you are told that whenever the parent company has acquired a subsidiary, the parent company may pay the purchase consideration by issuing its own shares. So therefore, these are the shares issued by the company to pay for an asset, to pay for services, to pay for goods which have been provided or basically bought by the company. And these shares which have been issued by the company to pay the purchase consideration, they are treated as an equivalent. They are treated as an equivalent of the shares issued at full market price. So if they are treated as an equivalent of the shares issued at full market price, it basically means that these shares, when computing the one-offs, they should always be weighted on time basis. They should always be multiplied with the proportion of time they were held during that year. So then number four, we have the conversion, or basically we can talk over number 4, we can talk over issue of shares on conversion of convertible securities. Convertible securities. So what are convertible securities? Convertible securities are those are things like debentures, things like bonds which are issued by the company, but which are convertible in nature. Remember, in our previous topic on financial instruments, we talked about CFI, compound financial instrument, and actually we said that these are convertible securities issued by the company. So therefore, if a company has issued convertible securities and convertible debentures, we know the holders of those securities have the right to convert them into ordinary shares, And once they have converted them into ordinary shares, they will automatically be issued with what? Ordinary shares of the company. How do we treat those ordinary shares which have been issued by the company? Equally, the ordinary shares issued here on conversion, they are treated as an equivalent of issue at full market price. Issue at full market price. They are treated as an equivalent of the shares which have been issued at full market price. If that is the case, then those shares which were issued on conversion then should be weighted on time basis. They should be weighted on time what? Basis. They should be weighted on time basis. Then number five, we can talk of issue of bonus shares. Issue of bonus shares. Bonus shares are what? These are shares issued to the existing shareholders of the company, basically free of charge. Remember, we have said that these particular shares, number one, when computing the basic earnings per share, these shares are not weighted on time basis. They are not weighted on time basis. They should not be multiplied with the proportion of time the shares were held, even if the shares were issued like 2 months, 3 months to the end of the year. We assume the shares were issued at the start of the year. We assume the shares were issued at the start, simply because I've said in most of the cases these shares are issued to the existing shareholders. We assume the shares had been issued at the start. Don't multiply them with the proportion of time they were issued. Number two, if this particular, or if you're given information about 2 years, like in this case, assuming you're given information about 2024 here, 24, and basically 2023, and you're told the current year is the year 2024, you are computing the basic earnings per share for 2024, and then you're told during this year, the company made a bonus issue. Now, in this case, if you're given information about what? About the previous financial year, about the previous reporting period, that is now 2023. Equally, in this case, we assume that the shares were not issued at the start of the current year. We assume the shares were issued at the start of 2023. So if the company made a bonus issue in course of the current financial year, and you're given information about the previous reporting period, then we assume those shares were issued at the start of 2023. What is the implication of that assumption? The implication of that assumption will be two things. One, during the year 2024, those shares should not be weighted on time basis. That is something you've already mentioned there. Number two, these particular shares, we also use them to restate, or in other terms, to adjust the earnings per share of the previous year. We use them to adjust or to restate the earnings per share for the previous year. Remember, the earnings per share for this year, the basic earnings per share for this year has already been computed. But now we ask ourselves, when the basic earnings per share for this year was computed, did the company use these bonus shares, which were issued in the year 2024? Automatically, no, because in computing the basic earnings per share for a certain year, use the shares issued and fully paid at the end of that year. But remember, in our case, what you have said here, the shares which were issued free of charge during this year, we assume they were issued at the start of this year. And because when the earnings per share for this year was computed, those shares were not taken into account, we have to compute it afresh. We have to compute the earnings per share for this year afresh. And basically, how do we compute that restated or that adjusted earnings per share? To compute the adjusted basic earnings per share of maybe this year, that is the previous year, we can just refer to it as the previous year. We take the PATOS for this year. Basically, let's also refer to that as the previous year. We divide that with our NOS for the previous year, which is 2023, previous year. But now to this one-NOS, to this particular one-NOS which we have down there is something which we add. So what do we add to that one-NOS? What do we add to that one-NOS? So to this one-NOS, there is something which we add, which is basically the bonus shares which were issued during the current year. The bonus shares which were issued during the current year. CY for current what? Year. The bonus shares issued during the current year. So therefore, that's basically how we deal with the bonus shares. Those particular shares are assumed to have been issued at the start of the previous reporting period. The implication of that is that during the current year, don't weigh them on time basis. And number two, use them to restate, to compute compute the earnings per share for the previous year afresh. So then from there, I want us to look on the other reason why the number of shares issued during the current year may change. Number six, and that is something called shares issued in exercise of a stock, or basically in exercise of a share option. Shares issued in exercise of a stock or a share option. So what do you mean by a stock or a share option? This is basically a privilege which is given to the employees of the company to buy the company shares at a price which is below the market price if those employees meet certain conditions. It is a privilege which will be given to you as an employee to buy the company shares at a certain price if you meet certain conditions. If, for example, in this case, you can secure a job with a certain company and you're told that if you work with that company for the next 5 years, at the end of the 5th year, you will have the right, you'll be given a privilege to buy the company shares at a price which is below the market price. That is a share, or basically a stock option which has been granted to you as an employee of that company. Now, in this case, when talk about exercise of the stock option, it basically means that the employees have satisfied the condition which was set by the company, and they have gone further to buy the shares promised. So meaning that here, the shares will be issued. The shares will be issued to company employees, at a price which is below the market price. The shares which will be issued to the company employees at a price below the market price. Now, in this case, if the company issues shares, or anytime the company issues shares at a price below the market price, like in this case, in case of a stock option, then it is assumed that some of the shares have been issued at full market price and other shares have been issued free of charge. So therefore here, the shares issued during the stock, or basically the share option, because they will be issued at a price below the market price, we split them into two components. The first component is the issue at full market price, and number two is the shares issued free of charge. The shares issued free of charge is known as a bonus element. Those shares are known as a bonus element in the stock option. These are the shares issued free of charge. The shares issued at full market price, this one are computed by computing how much amount was received by the company. If the company issued 2 million shares to the employees at a price of 30 shillings, which is automatically below the market price, the amount received will be 2 million times 30. That is the amount received. And then divide this with the issue price. With the issue, sorry, not the issue price, but we divide this with something called the average market price. The average market price. So this will give you the shares which were issued at full market price. And then in this case, you have to recall, anytime the shares have been issued at full market price, you have to remember our golden rule, that those shares must always be multiplied with the proportion of time they were held. Then from there, we determine the bonus element. Bonus element are the shares deemed to be issued free of charge. How do we compute this? Take into account the total shares which were issued. How many shares were issued to the employees? Assuming, like in this case, will be 2 million. Those are the shares issued to the employees. And then to this, we deduct issue at full market price. This is what we will have computed up here. The shares issued at full market price. That will give us the bonus element. Bonus element have said are the shares regarded to be issued free of charge. You have to recall those shares which are issued free of charge during the current year. We have said two things in relation to such shares. Number one, during the current year, don't waste them on time basis, because these are just equivalent to bonus shares. Don't waste them on time basis during the current year. And number two, you also use those shares to do what? To restate or to adjust the earnings per share of the previous year. So when doing that, this is basically the formula you use. You use those particular shares to restate the earnings per share of the previous year. During the current year, don't waste them on time basis. And then finally, I want us to discuss about a very important concept, which is tested in almost all these questions for earnings per share, and that is a right issue. We need to ask ourselves, what is a right issue? A right issue, basically, we know this is an issue of existing, it is an issue of additional shares to the existing shareholders of the company at a price below the market price. So here, the shares will be issued to the existing shareholders of the company at a price below market price per share. So you can see there is some similarity between the right issue and the stock option. So the only difference is that here the shares are issued to the employees, here the shares are issued to the existing shareholders. But in both cases, the shares are issued at a price below the market price. Now, if that is the case, then these shares which are issued by the company during the right issue, just like what you have said up here, because they were issued at a price below the market price, we also split them into two components. We also split them into two components: the issue at full market price, and the bonus element. So how do we compute this issue at full market price? So we use the same approach, but there is a slight difference. So here we first of all compute the amount which was received by the company. And then in this case, do we divide that still with the average market price per share? No. We divide this with something you came across in FM known as theoretical X-rate price. And basically, this is a price which is always computed. The examiner will not give you this one. You do what? You compute it. There is a formula you're using in FM, but in this case, I'll be able to show you a simple approach of computing that without necessarily using a formula of computing the theoretical X-rate price. Theoretical X-rate price basically is the expected market price per share after right issue. After the company has made the right issue, the shares of the company will be trading in the securities exchange market at which price? And then you also have to recall these shares must be weighted on time basis. And then from there, we compute the bonus element. The computation of the bonus element is the same. We take the total shares issued. How many shares were issued to the existing shareholders? We divide that with the issue at full market price, which we will have computed up here using that formula. And then you also have to recall that these shares are not weighted on time basis. Those shares should not be weighted on time basis. And number two, we also use those particular shares in restating or basically adjusting the earnings per share of the previous year. So basically, that is what is important for you to note. How do we specifically treat these particular shares which have been issued by the company during the current financial year, specifically in the computation of of the basic earnings per share? Now, what I want us to do, I want us to just take a breather, and then once we come back, I want us to do a question on this. A question purely examining on computation of basic earnings per share. If you check on most of the questions from the past papers, you'll be able to see they require the computation of both the basic and diluted. I want us to start by looking on a question which was pure testing on the computation of basic earnings per share. And this is the question I want us to do. There is a question from the sitting of 2018. Will I be able to get the question number? No, I can't be able to get that now, but basically, okay, can you go to this meeting of 2018? You should be able to see a question on earnings per share, basic earnings per share. This one, basic earnings per share. You have the question with you. And then once we come back after the short break of 6 minutes, we come back at 7:10. I want us to do this question. Sasa? Yes. So let's just take that short break of 6 minutes, and then we come back at 7:10. So see you after that short break. Yeah. Yes. So the question, that is the question number 5. Basically B. We can start with 5B. Question 5B, but C is the one which has some computation. So in B, what are we told? We are told to discuss the significance of the earnings per share EPS figure in the analysis of the performance of the company. So basically, what the examiner was asking here is what is the importance of the earnings per share, which you have said has to be computed and disclosed by all the listed companies. Number one, you have said earnings per share is basically used in terms of computing the price-earning ratio. Number two, you have said is used by the shareholders to evaluate the company's profitability. Number three, you have said it can also be used by the shareholders to do what? to compare performance of different companies within the same industry, and also to compare the performance of the company in different years. In different years. Those are like the 4 uses of this price earning ratio. Then in part B, part C, that is, we are told that IAS 33 earnings per share set out the requirement for calculating and disclosing the basic earnings per share figure for quoted companies. So we are told the following figures appeared in the consolidated income statement and other comprehensive income of 𝗲𝐻𝐶 Limited for the year which ended 31st of July 2018, together with the comparative for the year which ended 31st of July 2017. So we're given information about 2 years, 2018, 2017. We have the profit before tax, we have the income tax expense, profit after tax, and then we have other comprehensive income, which include the revaluation gain on land. We have the total comprehensive income, profit after tax for the year attributable to the owners of the group and also attributable to NCI. So basically here, or this is a group of companies. And then you're also given the total comprehensive income for the year attributable to the owners of the group and also NCI. Then we are given the statement of financial position extract as at 31st of July 2018, together with a comparative for the year which ended 31st of July 2017, which were as follows. So that is the statement of financial position extract for 2018-2017. So we have the equity share capital, which is the same with the ordinary share capital. We have the 4% preference share capital, share premium, other equity reserves, non-controlling interest, retained earnings, and then we have the total equity. And then you're told during the year, which ended 31st of July 2018, the following transactions took place in relation to the issued share capital of 𝗲𝐻𝐶. Number one, you're told 100 million equity shares were issued in relation to the acquisition of another business. The shares were issued at full market price on 1st November 2017. 2, 150,000 ordinary shares were issued for cash to the existing shareholders on 1st January 2018. The issue price was shillings 1.5 per share, which represents a discount of 25% on the traded price of shillings 2 per share immediately before the issue. Number 3, we are told on 30th of June 2018, a bonus issue was completed by capitalizing shillings 135 million of the retained earnings. Finally, you are told on 31st of July 2018, the preference dividends for the year and the equity dividends of shillings 23 million were paid. And then what are we required to do here? Roman 1, we are required to compute the basic earnings per share for the year which ended 31st July of 2017 and 31st of July 2018, 10 marks. And then Roman 2, we are required to compute the comparative earnings per share for the year 2017 to be reported in the year 2018 financial statement. And then you're told the EPS figure reported in 2017 was 0.525. So in this case, we're going to start with Roman 1. And basically in Roman 1, we are required to compute the earnings per share for 2 years. That is 2017 and 2018. 2017 and 2018. So let's start by computing the basic earnings per share. Anytime you're given 2 years, like in our case, 2017, 2018, you must start by computing the basic earnings for the first year, 2017. Then we compute for 2018. So here we will start by computing the basic earnings per share, or basically in part A, Roman 1, sorry, we are required to compute the basic earnings per share for the year which ended 31st of July 2017 and 31st of July 2018. So in this case, I'm saying we will start by computing the basic earnings per share for 2017, basic earnings per share for the year which ended 31st of December 2017. And then from there, we will proceed and compute the basic earnings per share for 2018. So how do we compute this basic earnings per share? The first thing we must always recall is the formula. How do we compute the basic earnings per share? Remember, we have said that this one is equal to the PATOS, to the profit attributable to ordinary shareholders. We divide that with what? With 1/0. So basically in FR, formulas are not marked, unlike in FM. FM formulas are marked. So in FR, formulas are not marked. So this is basically to guide you. So you can use that in short form, provided you can be able to recall what is PATOS, how we compute that, and you can be able to recall what is 1/0 and how you compute that, or how we compute that. That formula will not give you any mark. It's purely to guide you. So I want us to start by computing this one. the PATOS, the profits attributable to ordinary shareholders. Recall how we compute this. We have said to compute this one, we take the profit after tax, which is also known as the net income, or the profit for the year, the profit for the year, and then to this we have said we less what? We less the preference dividend, for the current year. We also less what? We also less the profit attributable to NCI. In case we are told this profit include a loss from discontinued operation, we come here and we add the loss from the discontinued operations. So if you can recall, in this question, there is no way we are told there was a loss from discontinued operation. So let's just plug in these figures. It is also important for you to see that our figures are given in millions of shillings. And remember, we are computing the PATOS for 2017. So we will go back to the information we have in paragraph 2, where we have the statement of profit and loss, or the statement or the income statement extract. We go to the income statement extract for 2017. And can you give me the profit after tax for 2017? Profit after tax of 2017, who can see that? Below paragraph 2. Below paragraph 2, profit after tax. Profit after tax is 240 million. 240 million. I hope you can see that, 240. So to this, we need to less the preference dividend. And are we given preference dividends in this case? No. But if you go to the information we have under paragraph 3, specifically where we have the statement of financial position extract, so you can see this company had issued ordinary shares, and equal the company had issued 4% preference shares. What we have said, you have to be very, very careful here, is to check whether the preference shares which you are given are redeemable. So if they are redeemable, never make a mistake of raising their dividends here, because you have said in arriving at this profit, those dividends on redeemable preference shares have already been deducted as part of the finance cost. But are those preference shares redeemable? No. So you have to compute how much preference dividends were supposed to be paid by this company. The preference dividends which the company was supposed to pay will be equal to 4%, because you can see the preference shares issued by this company are 4%. This company has an obligation to pay preference dividend of 4% of the preference share capital each year. So we take 4% times the amount of preference share capital. The amount of preference share capital is what? Is 100 million. 100 million in both years, 2018 and 2017. So this will give us what? This will give us what? Will that give us 4 million? Yes, 4 million. 4 million. And then from there we proceed and we less the profits attributable to NCI. Who can give us this one? This one we have it below paragraph 2, where we have the income statement extract. The profit for the year attributable to NCI. Profit for the year attributable to NCI. How much is that? Profit for the year attributable to NCI. Who can see that figure somewhere? For 2017, the profit for the year attributable to NCI. And you also have to be very, very careful here. We have the total comprehensive income attributable to NCI, and then we have the profit after tax attributable to NCI. So I can see I'm given a figure for that, yes. So in this case, we take the profit after tax attributable to NCI for 2017, and that is basically 30. That is 30. In this case, we don't have any loss from discontinued operation. So basically what we do, we less those two figures from 240, whatever you get down here is the PATOS. So how much would be our PATOS here? Yes, the PATOS for this year will be 206 million. 206 million. So having that, then we need to move and we compute the one-offs. We need to move and we compute the one-offs, the weighted average number of ordinary shares. So how do we compute this one? I've said to compute this, we take the ordinary shares issued and fully paid at the start, and then we add the other shares which were issued by the company during the current year. But before even we compute this one, it's important for you to note, in this question here, we have 2 years. We are given 2 financial years. The first year ended on 31st of July 2017. The second year ended on 31st of July 2018. So this is the first year, this is the second year. So therefore, what we need to do here is basically to determine how many shares, how many ordinary shares had been issued and fully paid at the start of the first year. And then we have to add the other shares which were issued within this first year. We will not consider the shares which were issued within the second year. We only consider the shares which were issued during the first year. Sasa? Yes. So which information have we given in relation to the shares issued in 2017 in the first year? Now, in the information which we have, actually in the additional information where we have note 1, 2, 3 up to note 4, we are told just before note 1, we are told during the year which ended 31st of July 2018, basically that is the second year. The second year, the following transactions took place in relation to the issued share capital. So basically those transactions we are given in note 1, 2, 3, 4. They took place in which year? They are transaction for which year? The second year. Basically, we can just confirm, like the first transaction, note 1, we are told 100 million shares in relation to the acquisition of another business. These shares were issued in sentence 2 on 1st November 2017. So you can see the first year ended 31st July. 1st November 2017 is within the second year here. Then the other transaction on second, 150 million ordinary shares were issued on 1st Feb 2018. 1st Feb 2018, still within the second year. Number 3, on 30th June 2018. 30th June 2018, still within the second year. And then number 4, on 31st July. 31st July 2018, still within the second year. So all those transactions basically they relate to year 2 here. So in relation to year 1, we are not given any information about the shares which were issued. Now, what we are given in relation to note 1 is the information we have at the paragraph 3. Can we go to paragraph 3 where we have the statement of financial position? We are given the statement of financial position extract for the year which ended 31st of July 2017 and 31st of July 2018 and 31st of July 2017. So what we can only be able to do as far as first year is concerned is basically to determine the ordinary shares which were issued here, because you can see we are given the statement of financial position at the end of this year. In that statement of financial position, we are given the share capital at the end of 2017. So how much was the ordinary share capital of the company at the end of 2017? The ordinary share capital of the company at the end of 2017. Equity share capital. Equity share capital is the same with the ordinary share capital. Ordinary share capital of the company at the end of 2017, how much is that? How much was that? How much was that? How much was that? That was 200 million. That was 200 million. So basically what that means is that in our case, we can only be able to determine the number of ordinary shares which were issued and fully paid at the end of 2017. How do we compute those shares? We will take 200 million, which is the share capital. These are not the shares, 200 million. And then for us to be able to know the shares, we divide that with the par value per share. I hope you can see the par value per share, where we have still in our statement of financial position, where we have the name equity share capital. Into the bracket, inside the bracket, we are told the par value per share is what? 0.5. So that will give us the number of ordinary shares which have been issued at the end of 2017. So it will be 200 divided by 0.5. So this will give us 400 million ordinary shares. So that's what we have. And basically, in this case, we are saying during this year, there is no transaction we are given. There is nowhere we are told there were shares which were issued during this during that year. So if that is the case, then we assume, or not the assumption, actually that is the fact, that if there were no shares which were issued during this year, and you're given the shares issued at the start, then the shares issued at the start were the same. There were no shares which were issued here. So the shares issued here and here were the same. Is that the case? Yes. So therefore, to compute this one north, we have to remember that the first year here will start, even here is ending July, the other year will start August. This year started 1st August 2016. That is when the first year started. 1st August 2016. Because you have said in computation of this, we take the shares which have been issued at the start. Basically, we refer to that as balance brought down. Balance brought down are the number of ordinary shares which were outstanding at the start of the year. Outstanding at the start of the year. So in this case, we are saying there will be 400 million, because if there were no shares which were issued during that year, and we know the shares issued here, the shares issued at the start were the same. And then in this case, we have said we add the shares which were issued during this year. So in our case, we know there was no issue of shares. There was no issue of shares during this year. There are no shares which were issued. Basically, what that means is that the one-offs remain the same. The one-offs, the weighted average number of ordinary shares will be what? Will be 400 million. Are we together up to that point? Are we together up to that point? If yes, we can compute the basic earnings per what? Per share. So the basic earnings per share, we apply our formula here. We take the PATOS, which is this one, 206 million. We divide that with the one-offs, which is this one, 400. And the answer which we get here, we express it as shillings per share. Shillings per share. Shillings per what? Per share. So what will be the earnings per share here? Yes, the earnings per share, I'm told, will be 0.515 per what? Per share. This is the amount of earnings. This is the amount of profit attributable to each ordinary share. Attributable to each ordinary share. So we are done with the first year. I want us to move to year 2. Let's move to year 2 here. We move to year 2. That is basically the year which ended 31st of July 2018. We compute the basic earnings per share for the year which ended 31st of July 2018. So do we need to repeat the formula? No, because we have seen this formula is just to guide us. So we start by computing the PATOS. The PATOS for the second year, the computation for this actually will not change. We are using the same approach. We take the profit after tax, we less the preference dividends. We less the preference dividends. We also less the profit attributable to NCI. And then in this case, we have said we add any loss from discontinued operations. So in our case, we know that we don't have any loss from discontinued operations. So we just need to plug in these figures now. We just plug in these figures. So the profit after tax, we go to the information we have below paragraph 2. Profit after tax for 2018. For 2018, who can see that figure? Who can see that figure? Is it 325? The profit after tax, is it 3.5? 325, confirmed by Gilbert. Yes, 325. So to this, we less the preference dividend. The preference dividend, the computation will be the same. So we take the rate, which is 4%, times the amount of preferential capital. The preferential capital of 2018 remained the same. The preferential capital in 2017-2018 was the same. So that will give us 4. And then we also less the profit for the year attributable to NCI. Profit for the year attributable to NCI, how much? Profit for the year attributable to NCI, 45. And then in this case, we have any loss from discontinued operation? No. So basically what we need to do here is we compute the one-offs. We compute the weighted average number of, sorry, not the one-offs, sorry. This should be the PATOS. This should be the PATOS. 325 minus 49. So which will give us 276. So having that, then we need to move and we compute the weighted average number of ordinary shares. That is the weighted average number of ordinary shares for one-offs. And basically this, remember also here figures are in millions, but remember shares are not in shillings. These are number of shares. The number of shares which are in million of shillings. So what do we start with here? Recall our formula. We take the shares issued and fully paid at the start of the year, and then we add the other shares which the company issued during the current year. So the second year, remember the first year ended 31st July 2017. So the second year will start 1st of August 2017. So the second year started 1st of August 2017. So we start by determining how many ordinary shares had been issued and fully paid at the start of the year. So this one is automatically not given. But we can use the information for the previous year to know the shares issued and fully paid at the start of the current year. Who can tell me how many shares were issued and fully paid at the start of the current year? I'm told by Otunga they were 400 million. There were 400 million. Is that the case? Is that the case, Diana? Is that the case, Eddie? Is that the case, Frida, Gordon, Ismail, Isabella, Kelvin, Mercy, Mike, Phoebe? Are the number of ordinary shares issued and fully paid at the start of the second year 400 million? Are they 400 million? Yes, automatically they were 400 million. So because the shares which were issued and fully paid at the end of 2017, the first year, those would be the shares issued and fully paid at the start of the second year. The closing balance in 1 year is the opening balance. As simple as that. The shares issued and fully paid at the end of 2017, 400. Those are the opening number of shares issued at the start of the second year. So here, the shares which were issued and fully paid at the start of the second year are these one. And then now to this, what do? We add the other shares which were issued by the company during the current year. Now remember, in the additional information, note number 1, 2, 3, 4, we are given information about the shares which were issued during the current year. We need to go there now. In note number 1, what are we to? Let's go to note number 1, and here we need to be together so that you understand what you're doing. So we are told 100 million equity shares were issued in relation to the acquisition of a business purchase. Now, if you're told shares were issued in relation to a business purchase, these are the shares which were issued by the company in payment of a purchase consideration. Shares issued by the company in payment of purchase consideration, we have said for the purpose of computing one-offs, we need to multiply them with the proportion of time they were held. In other terms, we treat those shares as an equivalent of the shares issued at full market price. That's what you can see in the other sentence. We are told the shares were issued at full market price on 1st November 2017. So the shares were issued on 1st November 2017. I hope you can see how I'm arranging my work. You must always start with the date. A short description of the transaction. Here we can say we have an issue of shares as a payment of purchase consideration. As a payment of purchase consideration. So how many shares were issued in that case? The shares issued were 100 million. 100 million. And then you have to recall we have said shares issued to pay as a payment of purchase consideration, we weigh them on time basis. We multiply them with the proportion of time they were held during that year. So these shares were held for how many months? Take into account they were issued on November and the year started August. So they will be held in November of 2017, December of 2017, and then remember our year is when ending when? 31st July 2018. In 2018, they will be held for how many years? 2018, they will be held for 7 months, sorry, 7 months. 7 months, and then in 2017, let me put it here, so in 2017, we are saying they will be held in November and December, 2 months. In 2018, they will be held for 7 months. 7 months. So in total, these shares were held for 9 months. So we multiply this with the proportion of time the shares were held, which is 9 all over 12. 9 all over 12 is the same as 3/4. 3/4 of this is what? 75. Yes. So that's basically how we treat those shares. Let's go to note number 2. And you're told 150 million ordinary shares were issued for cash to the existing shareholders of the company on 1st of February 2018. So these shares were issued at 1.5 shillings, which represent 25%, a discount of 25% of the traded price of shillings 2 per share immediately prior the issue. Now, what is this? Who can tell us? The shares issued to the existing shareholders, but at a price below the market price. Which name is given to that transaction? Which name is given to that transaction? Shares issued to the existing shareholders of the company, but at a price below the market price. At a price below the market price. Yes, this is a right issue. This is a right issue. A right issue, we have said, is a very, very common transaction in these questions for earnings per share. The transaction was on 1st February 2018, and basically there was a right word, a right issue. Recall we have said that anytime the company make a rights issue, these shares must be split into two components, into the shares issued at full market price and the shares issued at nil consideration. That's basically what you have to recall. So we compute here how many shares were issued at full market price. Remember, I've given you a formula. To compute this, I've said we compute the amount received divided that with theoretical X-rate price. Those shares then should be weighted on time basis. Roman 2, we compute the bonus element. We compute the bonus element. These are the shares which were issued free of charge. But for us to be able to compute these two items, there is a price which we have mentioned, which you have to compute, which will never be given by the examiner. Which is that price? The price is theoretical X-rate what? A price. Theoretical X-rate a price. There is a certain formula you used to you are using in FM. So in this case, do you have to use that formula here? No, you don't have to use that formula. There is an easy approach of computing that. An easy approach of computing that. Although it's just the same. It's just the same with what you are doing. Is the same with what you are doing in FM. So basically here to compute this one, what we do is that first of all, we take the shares which were held before the right issue. How many shares were held before the right issue? And then we also consider the shares which were issued during the right what? The right issue. For example, in this case, we already have this one. How many shares were issued during the right issue as per that note number 2? The shares issued during the right issue were 150 million shares. And then in this case, were issued at a price of what? Each share during the right issue, who can tell us, was to be issued at a price of what? So remember, always during the right issue, the shares will be issued at a price below the market price. Below the market price. In that case, we are given two prices. We are given 1.5, and then we have 2 shillings. So the shares were issued at a price of 1.5. That is the issue price. So the company issued 150 million shares at a price of 1.5. These are the shares which were issued during the right issue. Then we need to ask ourselves, how many shares were held before the right issue? And those shares had a market price of what? First of all, we know the market price per share before the right issue or 2 bob. But we need to determine how many shares were held before. So that one, you can't get it in that note. You can only get that from the computation which we have here. The shares which were held before the right issue are these one, 400, plus the shares which were issued here. How many shares were issued on 1st November 2017 here? How many shares were issued by the company here? Did the company issue 75 million? Did the company issue 100 million? How many shares were issued there? Who can tell us? Who can tell us? So in this case here, we consider the actual, because on this date, the company issued the right issue. The shares which were trading the securities exchange market, they were not 475, this plus this, but rather they were 400 plus the actual shares which were issued here. The actual shares which were issued here were 100 million. So therefore, the shares which had been issued before the right issue were 400 plus what? 100. Never make a mistake, because this is one of the mistakes majority of the students do, to take these shares. Remember, these shares have already been multiplied with the proportion of time. Take the actual shares which were issued here, 400 plus 100. So therefore, the shares which were held before the right issue were 500 million shares, and each share was trading at a price of what? At a price of 2. So if you have this, then computation of theoretical X-rate price becomes very simple. And remember, we have said that the theoretical X-rate price, this is the expected market price per share after the right issue. So the shares of the company, the securities exchange market, will be trading at a price of what? After the right issue. So how do we compute that? First of all, we determine the total shares which will be issued after the right issue, which will be 650 million, this plus this, and then determine the market capitalization. Market capitalization is the total market price of all shares which will have been issued by the company after the right what? Issue. So how do we get the market capitalization? This times this, which will give us 1,000 million, and then this times this, 150 times 1.5, which will give us 225 what? Million. The market capitalization of these shares, or the market price of these shares, will be this plus this, which will be 12.25 million. So therefore, to get the theoretical right price, we take what? We take this, because after the right issue, all the shares of the company will be having a market price of 12.25 million. This will be the market price of how many shares? Of 650. So what will be the market price of one share after the right issue? Take the total market price of all the company shares, divide that with the shares issued by the company. 12.25 divided by what? Divided that with 650, which will give us 1.885 shillings per what? Per share. And always in this case, the theoretical right price which you get here should always be below, slightly below the market price before. So remember, the market price per share before the right issue was 2 shillings. But once the company make a right issue, there is a slight decline in the market price per share. So this is the theoretical right price. Having that, then we come back here, and always this the theoretical right price that has always a mark. There is a mark which is allocated for computing that. Now, having that, I want us to come back here. We split these shares which were issued during the right issue into 2 components. How many shares were issued at full market price? We just need to recall the formula which I've given you. The amount received, compute how much amount was received by the company from these shares which were issued. The amount received will be equal to the shares which were issued during the right issue, 150. We know these shares were issued at a price of 1.5 shillings per share. And then divide that with the theoretical right price, whatever you have computed here, 1.885. And then we have said these shares, because they were issued at full market price, you must multiply them with the proportion of time they were held. So these shares were held for how many months? From Feb to the end of the year. The year, remember, ended on this date. Were the shares held for 6 months out of 12? Are they held for 6 months out of 12? Yes, they were held for 6 months, because in 2018, we should not include January. They were held from Feb. Feb is the second month up to the end of July. Those are 6. Then from there, we compute the bonus element. The bonus element, this one is equal to, you just need to record the formula. The total shares issued during the right issue, 150, minus the shares which were issued at full market price. The shares issued at full market price is not the final answer you get here, but basically these are the shares issued at full market price. Whatever you have here, just transfer this down here. 150 million times 1.5 divided by 1.885. These are the shares issued at full market price. And then you have to recall, these shares should not be weighted on time basis. Those shares, we assume they were issued at the start of the early reported period. We don't weight them on time basis. So let's work out that now. 150 times 1.5 divided by 1.885, and then we get half of that, which will give us 59.68. What about this one? And this one, we have 150 times 1.5 divided by 1.885. We less that from 150, which will give us 30.6 what? 4. 30.64. 30.64. Yes, that's basically how we deal with that right issue. And this is something we will be able to see. We will basically we will come across this concept of right issue in almost all questions for earnings per share. Let's move and deal with the next transaction. And you are told on 30th of June 2018, the bonus issue was completed by capitalizing shillings 135 million of the retained earnings. So we are told on 30th of June, that is another transaction for the issue of shares. There was a bonus issue. There was a bonus issue. The company issued shares free of charge. Free of what? Free of charge. Free of charge. Otunga, we are saying you compute this. You compute whatever you have here. You less it from 150. You less it from 150. Whatever you're getting here. 150 times 1.5 divided by this. These are the shares issued at full market price. Less them. Whatever you get, you less that from 150. Should give you 30.6 what? 4. 30.64. That the case? Yes. So then, in this case, we are told there was a bonus issue. But during this bonus issue, are we given the shares which were issued? No. We are given the value of the shares. The value of the shares which were issued were 135 million. It is important for you to note that anytime the company is making a bonus issue, the shares are always issued at the par value. The shares are always issued at the par value. Take into account, this is the total value of the shares. Remember, in our case, we're interested with the shares which were issued during the bonus issue. How many shares were issued? For us to be able to know the shares which were issued, we have to divide this with the par value. And I hope you can be able to remember the par value per share is 0.5. Can you remember that? 0.5. This will give us the value of the shares which were issued during the right issue. Not during the right issue, during the bonus issue. I've taken 135, which is the value, shillings 135. That's why I'm saying these are not the shares. I hope you can see the word shillings. Shillings is the value of the shares. How do I get the number? I divide that with the par value. I've said always, during the bonus issue, the shares are issued at their par value. The par value is 0.5. And this will give us what? 270. Remember, these shares are not weighted on time basis. They are not weighted on time what? Basis. And I think we are done because in the last note number 4 is about dividend. It's all about dividend. So it's not about the shares which were issued. So what we need to do is now we compute the one-offs, weighted average number of ordinary shares. To compute that, we add all this. 400 plus this, plus this, plus this, plus that. So what do we get here? We have 400 plus 75 plus 59.68 plus 30.64 plus 270. Now I'm getting 835.32. I hope that is what you're getting. So if that is what you're getting, I think finally we can compute the basic earnings per share for 2018. So we take the PATOS, which is here, 276, divided that with the one-offs, which is 835.32. So that will give us what? 276 divided by the answer. Okay, 276 divided by 835.32. I'm getting shillings 0.33 shillings per what? Shillings per share. Yes, so that basically what was required in such a question. What is marked are these items there. These are the figures which will be marked there. So let's wind up because I can see our time is almost over here. Yes, so what have we required in the last part of these questions there? In the last part, Roman 2. In Roman 2, we are required to compute the comparative earnings per share of 2017 to be reported in 2018 financial statement. And then you're told the EPS figure reported in 2017 was 0.525. Okay, I don't know what that refers to, but if you can be able to recall, we have computed the earnings per share for 2017. It was 0.1. It was 0.515, not 0.2525. Maybe that was basically typing, but it should be 0.515. So what we are required to compute in other terms in Roman 2, is something known as the restated. The restated, in other terms, is something called the adjusted earnings per share for 2017. There is something I've explained in our introduction, whereby I've said if you're given 2 years, like in our case, you can see we have 2 years, 2018 and 2017. So if we are told during the current year, which is 2018, the company issued shares free of charge. The company issued bonus shares. We have said that these shares are assumed to be issued at the start of the first year. And therefore, because when computing the earnings per share during this year, we never use these bonus shares, we have to restate. We have to adjust the earnings per share for the first year. How do we do that? You just need to record the formula for computing these restated or these adjusted earnings per what? Per share. So we have said to compute this one, we take the PATOS basically for 2017 this year, 2017. We divide that with the one-offs, still for previous year, which is 2017. And then to this, we have said we add the bonus shares issued during the current year. The current year is 2018. So to this, we add the bonus shares which were issued in 2018. Remember, I've given you that formula. So therefore, we will take the PATOS for 2017. The PATOS for 2017 was how much? You can be able to remind me that figure. PATOS for 2017. It was 300 minus 4 minus 30. Yes, it was 206. I hope you can remember that. PATOS used in the computation of basic earnings per share for 2017. And then there were notes, I can recall that was 400 million. And then to this, what do we add? To this one, we add the bonus shares, which were issued in 2017. In 2018, the bonus shares issued in 2018 during this year, we have two components. We have this bonus element, this one. This bonus element would be considered to be bonus shares. And then we also have this. We have two components, the bonus element and the bonus shares. So we have 30.64 plus what? Plus 270. Plus 270. So that's basically how we compute the adjusted or the stated earnings per share for 2017. For 2017. And in this case, I'm given a figure of what? 0.94294. Shillings per share. Shillings per share. Is that what you're getting? Is that what you're getting? That is the figure I'm getting from Gilbert there. And the figure I'm getting from Gilbert, from Otunga, I'm getting the same. I'm getting the same from Phoebe, I'm getting the same. Yes, yes. So basically that is it, that what is required there, the computation of the stated or basically adjusted earnings per share for 2017. Sasa, yes. So that is it, that basically what is required in that question, and what you have been able to do there is to look on how we compute the basic earnings per share. So, but I've said that if you check on most of the questions from this topic, you'll be able to see they require the computation of basic and also the diluted earnings per share. So therefore, once we meet in the next class, we will go straight to this, or basically we will discuss what is diluted earnings per share. And then from there, we look on some questions in relation to how we compute what the diluted earnings per share. But for today, I want us to stop at that point. I don't know whether there is any question before we wind up. Is there any question before we wind up? Any question before we wind up? Yes, but basically you also make sure that before we meet in our next class, you have gone through what you have discussed, because even the questions which we will be doing, you'll also require this particular knowledge here. How do we compute the basic earnings per share? Because I've said most of the questions which are examined from this topic, they require the computation of basic and also the diluted earnings per share. So I think we stop at that point for today. We continue from there in our next class as we discuss on what is diluted earnings per share. There is also something we are requesting you assist us here. We have a Facebook account for the college. If you go to Facebook, basically you search Focus Online College. Focus Online College. We are requesting you assist us in terms of growing this account in terms of followers, because we need to be streaming write some videos. So we can only be able to do that once we hit 500 followers. 500 followers. I think currently we have around 220 followers. So we want to hit 500. So once you go to Facebook, please look for this account here, Focus Online College, and basically follow that page. Don't like. You can like, and maybe then you do what? You follow. Sasa? Yes, because I can see we are around 15 here. So can you give me 15 followers by the end of the day? Sasa? Yes, yes. So once you do that, we will be able to appreciate. Sasa? Yes. So we stop at that point for today. We continue from there in our next class as we look on the diluted earnings per share. So have a good night. See you tomorrow.